Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we'll be discussing one more technique of cost accounting, that is process costing. The process costing method is used where input is processed in different stages or in different machineries and finally output is arrived. You must be knowing that while we produce sugarcane is processed. Now that processing does not end in one step or one stage. There are series of activities or series of stages. Our input is first introduced in first stage. Thereby we get output in first stage. That output of first stage become input of second stage. Then we get output in second stage. That output of second stage will become input of third stage, and there may be after third stage we may get the final output. Now here in this case cost is added in each process. So for knowing the cost control or for having effective use of technology, we will try to know the cost at each stage. For that purpose we make use of process costing method. Under process costing method, accounting is done with the help of opening process account for various stages. That means if there are three stages of production, for example stage A, stage B and stage C, then we will have three process accounts, that is process A account, process B account and process C account. These accounts are open like simple ledger account what we open. Here on screen you can see that it is simply a ledger account open called as what? Process A account. Here it will have two sides, debit and credit, like for any ledger account. Here on debit side we will be recording all expenses of that particular process. For any process we require basic expenses like materials. Now here in case of material it is called as main input. For example, for production of sugar, the main input may be sugarcane. So here we are required to consider two things. One is quantity of input and the value of input. Now here we have columns like units and we have column rupees. Now this unit column will be used to denote quantity. For example, 1000 units are introduced of input, then 1000 will be recorded here in unit column and its value, say suppose rupees 10 per kg or rupees 10 per liter, then that amount becomes 10,000. This 10,000 will be recorded here in rupees column. So material, that is the main input, is recorded along with quantity and value. Then there is possibility of some additional material which we call as a secondary material, or it is called as a sundry material. In case of sundry material, the value will be recorded here in rupees column, but it will not have corresponding value in quantity column, because when we consider output quantity, we are going to consider only the quantity of main material. Sundry material therefore is not recorded in quantity column, it will be recorded only in rupees column. After material, the other expense relating to production comes to labor. So that is direct wages or direct labor. It is debited to process account. Now in case of labor also there will not be any question of quantity. You will be directly recording in rupees column the amount of direct wages or direct labor. Then we have overheads, or it is called as direct expenses. It will be recorded here in rupees column, direct expenses or overheads. So this is how all the expenses which are given in the question will be recorded to the debit of process account. Now here we are required to focus on these units which we have recorded against the column of direct material. These are called as what? Input units. Here in our example we have taken input 1000 units. So if there is input of 1000 units, are we going to get output also of 1000 units? So there is no possibility that we'll be getting entire amount in output, because in production process the material is being introduced in machinery, so there is possibility that we may be losing some of the quantity of input units, so output may not be equal to the input units. So in that case, in question they gave the amount of standard loss or the amount of normal loss. Now what is standard loss or what is normal loss? It is an unavoidable loss. That means if we are undertaking production, there is bound to be some units will be lost. That is called as what? Normal loss or standard loss. Because of the practice or in that particular industry, we can come to know about that standard loss. So for example, it may be given 10%. So standard loss is given 10%. This standard loss will have to calculate on the input units. So here input units are 1000 units. So standard loss is 10% of 1000. So it will be 100 units. From input quantity, if we deduct normal loss, we get here 900 units. Now these 900 units will be called as expected output. It will be called as what? Expected output or estimated output. That is what we are going to get from the usual production. Now this 100 units of normal loss will be recorded here on credit side. By normal loss, in units column will be recording here 100. So units are recorded of normal loss. Now here normal loss means those are bad production, those are bad units. Even though those are defective units of the product, there is possibility that we may get some scrap value from that. If we sell them those bad units, we may get some scrap value. So we are going to recover some amount. For example, that is given rupees 1 per unit. So here it is 100 units, rupees 1 per unit. That means we are going to get 100 rupees of scrap value. These 100 will be recorded here in rupees column to the credit of process account. So normal loss units are recorded here on credit side of process account, and its expected realizable value is recorded here in amount column. So from 1000 we have deducted 100, we got expected output 900. Now this will be compared with actual output. There is possibility that actual output also we got what is expected, that is 900 units. Here expected output and actual output both are equal. That means we got only normal loss. There is no any abnormal loss or abnormal gain arise in this particular process. Now here we will be closing this process account. First units column will be closed. It will show us the amount of output. If we have 1000 units here, debit total is 1000, credit side we have normal loss unit 100, so here output will be 900 units. This 900 units will have value, will take total of debit minus total of credit. Debit minus credit, we are going to get balancing figure here on credit side. That balancing figure here in rupees column indicates the value of output. What we have written here, by transfer to next process. Suppose next process is B process. So this output will be transferred to the next process. This is how usually process account is prepared and normal loss is recorded. Now what can be other variation in this case? Continuing the same example, if we have input 1000 units, normal loss 100 units, (900 units is normal output or expected output. Now here suppose actual output we got 895 units. Normal output we are expecting 900, actual we are getting lesser than that, we got 895. That means there is difference of 5 units. This is called as abnormal loss. Now what is abnormal loss? The loss which is not expected. What is expected is normal loss. What is not expected is an abnormal loss. Why abnormal loss arises? If the quality of material is bad, if worker is not expert, if machineries are not properly maintained, then there is possibility that over and above normal loss, we may come across abnormal loss units. These abnormal loss units are the losses for the processes. Now here abnormal loss is also recorded to the credit of process account. Here it is recorded abnormal loss. In units column we will be recording 5 units. We are required to value abnormal loss at cost of production because those were actually expected units of output. So we are required to do working note and we are required to find out the value of abnormal loss. How to find out that? We are having input value here 1000. Here we will be taking total of debit side, that is total of all expenses. Say suppose total of all expenses we had 11,000 rupees. Here normal loss is 100 units, say 1 rupee per unit. So here normal loss realized 100 rupees. So it becomes 10,900. That means expected output is 900 units and its value is 10,900. Now we are required to calculate the value of abnormal loss, for which we will be doing cross multiplication. The amount comes around 61 rupees. So this 61 rupees is an amount of abnormal loss and this abnormal loss will be recorded here in rupees column 61. This is how we calculate amount of abnormal loss units and abnormal loss value. Then we close process B account. As we have closed process A account, we will be getting balancing figure here in units column as well as in rupees column, that will be transferred to next process. For example, it is transferred to process C. So we have learned how to record process account when there is a normal loss, how to prepare process account when there is abnormal loss. Now one more variation is there, that is of abnormal gain. To understand abnormal gain, we will continue with our same example. Input is 1000 units. Its value debit, all expenses 11,000 minus normal loss 100 units. So what is the expected value here? Expected value is 900 units. Now actual output we got 910 units. We were expecting 900 units, but we got actual 910. That means here 10 units we got more. This is called as what? Abnormal gain account. Now these abnormal gain units are part of your final output. So those will be sold like a final output and it will be having cost like that of final output. Now how to value them? Normal loss is 100 rupees. Expected value 100. So value of expected cost is 10,900. Now we'll be doing cross multiplication to arrive at the amount of 10 abnormal units we are required to do. So after cross multiplication we got the value here 121. This is the value of abnormal gain units. This abnormal gain 10 units will be putting here on debit side. Abnormal gain units in quantity column we have put 10 units. Value is 121, that will be put in here rupees column 121. This is how we have recorded abnormal gain units as well as value. Then process account will be closed and the output will be transferred either to next process. Here suppose it is a process C is a last process, output will be transferred to finished stock account. So we have learned that in process account there are three possibilities. Possibility 1, normal loss. Possibility 2, there is possibility of abnormal gain, and third is abnormal loss. All three, how we are required to indicate, how we are required to calculate, we have discussed. If suppose the question asks further for preparation of normal loss account, how it has to be prepared. So here we have normal loss account. It will be prepared like simple ledger account. It will have two sides, debit and credit. Now here in every process, normal loss we credit. For example, just we have discussed process C. Here normal loss is credited here. So in every process we credit normal loss. So when we prepare normal loss account, we are required to debit the amount quantity of normal loss to normal loss account. For example, in process A, it is 100 units. Expected value is 1 rupee per unit. It will be 100 rupees. In process B, it may be 150 units. Per unit is, say, suppose 2 rupees. 300. In process C, it may be 200 units at the rate of 3 per unit. 600. So this is how in every process we calculate normal loss units on input. So those quantities we are required to record here in units column. In every process we are aware about the realizable value of input, where realizable value of scrap units, that will be recorded here in rupees column. Now in particular process, suppose normal loss we got fully, means in that process there is no abnormal gain. So all the units of normal loss will arise and all the units of abnormal loss will be sold. So in that case, say for example in process A, we were expecting normal loss 100, we were expecting 100 rupees and that has been actually sold. So on credit side we will be writing by actual sale of process A normal loss units, that is amount of whatever cash amount we have received, that will be recorded in units column, will be recording units 100 units. In amount column will be recording its value 100. That means if there is no abnormal gain, we have to record same thing here on credit side in units column 100 units and a rupees column rupees 100. Suppose in any process there is abnormal loss, that means we get a loss which is over and above normal loss. So it's very clear that whatever normal loss we have expected, that has also arisen in that process. So those units will be recorded on debit side. Example, in process B, suppose there is abnormal loss. So 150 normal loss units will be definitely there. So these 150 units will be sold and will be realizing their 300 rupees. What happens if there is in any case there is an abnormal gain? Say in this case, in case of process C, there is an abnormal gain, say of 50 units. So if there is abnormal gain of 50 units, we can't have arising of normal loss units 200 units. Because there is abnormal gain of 50 units, it will be lesser by 50 units. So actual units will be getting 150 and per unit rate is 3 rupees. So it will be 450. What we couldn't receive, that is a value of 50 units, 150 rupees. This will be transferred to abnormal gain account. Whatever shortfall is there, it will be transferred to abnormal gain account, and now we can close normal loss account. On closing normal loss account, units will tally, amount column will tally. This is how we prepare normal loss account. How to prepare abnormal loss account? As we have discussed, abnormal loss is credited to process account, like 5 units, value is 61 rupees. So it is credited to process account. So when we prepare abnormal loss account, it will be debited to abnormal loss account. So in this case, process B, units are 5 and value is 61. So we got abnormal loss 5 units and its cost of production is 61 rupees. Now these are bad units, abnormal loss, but it will be sold similarly that of what normal loss unit. In case of process B, normal loss unit per unit value is 3 rupees. Scrap value is 3 rupees. So it will be sold for 3 rupees. So 5 units sold at per unit 3 rupees. So we'll get some amount, that is 15 rupees. So this is a recovery of some amount of abnormal loss by sale of scrap. Now we can close this unit column is closed, that is 5 units. In amount column we get balancing figure 46 rupees. This 46 rupees will be transferred to costing, profit and loss account. This is how we prepare abnormal loss account. Finally, now abnormal gain account. In process account, abnormal gain is recorded on debit side. To abnormal gain 10 units, value is 121. So when we prepare abnormal gain account, this will be credited to abnormal gain account. So here we have credited to abnormal gain account 10 units and its value is 121. Now in that case, suppose scrap value of normal loss unit of that particular process is, say, suppose 2 rupees per unit. So normal loss we have not obtained because there is an abnormal gain. So there will be shortfall of normal loss 10 units. Per unit scrap value is 2 rupees. So it will be 20 rupees. So that will be debited here to normal loss account. We will be closing this now. Unit column is closed. Now we will be closing the amount column. Here we got balancing figure on debit side, that is 101 rupees. This is profit which will be transferred to costing, profit and loss account. This is how we have learned how to prepare normal loss account. Let us understand the various elements we may require to calculate in process costing after preparation of these 3 process accounts and abnormal loss, normal loss and abnormal gain account. Here we have what is to be calculated. If suppose we want to calculate normal loss, the formula which we are required to use, input multiplied by normal loss. For example, input is 1000 units, percentage of normal loss is 10%. So 10% of 1000, so normal loss unit will be here 100 units. This is how we can find out normal loss unit. Normal output we are required to find out. So input is, say, suppose 1000 units, normal loss 100 units, so 900 units will be normal output. If we are required to find out unit cost, the formula is normal cost divided by normal output, that is cost of process, that is total of debit side, total of all expenses, minus sale value of normal loss, that is scrap value of normal loss unit sold, divided by input minus normal loss. Input minus normal loss means expected output. If we want to calculate abnormal loss, the formula is normal output minus actual output. For example, normal output is 900, actual output we got 890. So 900 minus 890, 10 units will be abnormal loss units. Abnormal gain, actual output minus normal output. Actual output, say, suppose 910, expected was 900, so here 10 units is abnormal gain. That means here actual output is greater than normal output. In case of abnormal loss, actual output is less than normal output. If we are required to find out cost of actual output, we are required to see unit cost multiplied by units of actual output. Cost of abnormal loss, unit cost multiplied by units of abnormal loss. Cost of abnormal gain, unit cost multiplied by units of abnormal gain. These are the few formulas which will be useful while showing the answers for particular question we have apart from preparation of process cost account. Journal entries will be like this: normal loss account to process account, that is for sale value of normal loss. Next, process account to process account, that is for cost of goods of output. Abnormal loss account debit to process account, this is for cost of abnormal loss. Process account to abnormal gain account, that is for cost of abnormal gain. Actual sales, cash or credit sale if there are possibility will be of debtors, to normal loss account, units of normal loss multiplied by sale price. Cash received or credit sale to abnormal loss account, sale value of abnormal loss. Abnormal gain account to normal loss account, that is for sale value of abnormal gain. Costing profit and loss account to abnormal loss account, that is cost minus sale value of abnormal loss. Abnormal gain account to costing profit and loss account, that is cost of abnormal gain minus sale value of abnormal gains. This is how some of the important entries and relevant amount we can find out. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.